Hi everyone, it's Liana, ELA for Financial Information for Decision Making. I've had a student request me to do a video for question 4.1. So over here is the e-text 4.1, so it's chapter 4. These are all the transactions in it. Here, the answers are actually below here, but I will go through it on how to fill out this worksheet. So this is the blank worksheet you'll be provided. You do need to know this for possible assessment. But basically this is like a balance sheet and a P&L all in one. So you've got your assets here, your current assets and your non-current assets. So current means under 1 year. Non-current assets means over 1 year. Now when I see that, that is your lifespan. When we go over to current liabilities, this needs to be repaid within under 1 year. So that's your debt. And then non-current liabilities is over 1 year. So that's key difference between current and non-current. Over here is your owner's equity. Now you'll see that we've basically got a balance sheet here. What I want to quickly write in is our accounts within equity. And then this here is our profit and loss. Okay, so profit and loss is included in your balance sheet, but I just kind of want to help you. This will help your brain understand in terms of how to input the data. So what I've just highlighted in yellow is in essence what your balance sheet is. And then what I've highlighted in blue is in essence your P&L. So you'll see when you start creating balance sheets how your P&L actually comes within the owner's equity part of the balance sheet, but I won't explain that here. I think it's a bit too confusing at this point in time. But it's good to understand the difference here. So profit and loss, if we remember, I'll just make a little note here. Profit and loss equals revenue less expenses. Okay, so these two accounts are super important to know to fill out this worksheet. So step one is to fill out all the accounts we have up here in this bar. So the first one we have here is cash, which is a current asset, accounts receivable, and that's all we have for current assets. And across here, office furniture, and then office equipment. Okay, and then we go current liabilities, which is accounts payable. For this question, we don't have any other liabilities, we just have equity here. Now, what you can do is when you have your prior year's balance sheet, you can fill in the opening balances here. So let's say the prior year's balance sheet had a balance of $10,000, and let's say this was $5,000, you'd fill it in, so and so. But in this question, we aren't given the prior year's the information. If we had the prior year's information, we could also use that to complete up here. But what you'll find is you won't really know what accounts to put up in here until you actually start working through the transactions. So you kind of do up here, you figure out your transactions at the same time you work through your questions down here, your transactions. So in this case, we do not have an opening balance. If we were given opening balance details, we would input it here where I've just highlighted. So it would state, cash opening balance would be X amount, and then you just complete it. You might have an opening balance for equity, profit and loss, so you just complete it like that. Okay, so let's get straight into it. So here is where we put our dates down here. So we go, it is the 1st of October. So the question is, contributed $50,000 into the business bank account. So we need to think really logically here about what actually is occurring. I just want to double check something quickly. There we go. So what's occurring? We're getting an influx of money, so our cash at bank is going up positively by $50,000. Because this is an investment into the business, it's deemed as equity. So equity is going to go up by $50,000. There we go. So then here what we might want to do is write a short little description. So contributed funds into business. So super simple, just like that. So that's number one done. Number two. Okay, next one. Purchase desk and chair for office for $10,000 for Office Plus and paid cash. So paying cash, we know that we have to input something in cash. If we're purchasing something, our cash is going down, so it's a negative. And then the opposite side of that is we've now got an asset, which is our office furniture. So it's a positive because that account is increasing because we've got a value of $10,000 more of equipment. Okay, so that's it for that one. The next one is the 4th of October. Paid for office stationery, $560 from Supplies Inc. So office stationery, it's not an asset, it's something we use fairly regular, it's an expense. And we're also paying it for cash because it's an immediate thing, so we have to reduce cash balance by $560. Now the other side of that is an expense, which is the office stationery. So as I mentioned here, our P&L, see expense up here, anything to do with revenue or expenses has to go in our P&L column. So we make sure I'm putting it in the right one here. So it's a decrease of $560 in our P&L. So that's an expense. Okay, let's have a look at this one. Second, number 4, received $1,960 for provision of investment services. So that is revenue. So we're receiving money for services to be conducted. So it's revenue and we're getting cash in the bank straight away. So that's $1,960 cash, and as again I said, revenue is in our P&L, so that's a positive position here, $1,960. Perfect. Let's go down to the next transaction. Transaction number 8. So paid mobile phone bill of $356. So again, it's another expense and a cash payment. So we have to go negative $356. We go over to our profit and loss because it is an expense, and we go $356 in negatives. My apologies, I've forgotten to write the transactions up here, so let's quickly have a look. So we are going to say purchase office equipment, furniture. The 560, office stationery expense. The 960, provision for investment services. Might want to put brackets revenue. That might make it easier for you. The next one, sorry, is paid mobile phone bill. Okay, let's look at October 9th transaction. Received $1,280 from a customer for investment services. So that is revenue coming in, money coming through the door, so it's a positive to our cash, $1,280. It's also revenue, money, $1,280. So let's fix up my spelling, bill, and then we can just say even just revenue is sufficient there, I think. All right, so number 10, we paid an energy bill. Again, it's cash. So if they don't say it's on credit, they just say it's paid, it's always going to be cash. So it's a straight up event. Okay, and then because it's an expense, we're going back to our P&L. So we go brackets 404. So paid electricity bill. Hopefully by doing this, you're getting a bit more of the swing of things now. So the next one, owner purchased the partner a Tiffany ring with personal funds of $12,200. So it's saying here personal funds. This is nothing to do with the business. We totally ignore this transaction. It's nothing to do with the business. So we skip that completely. It's got no impact. So let's go on to the next one, 11. Purchased a computer and a printer on credit from JB Technologies, $5,000. So it is not a cash transaction. So what is it? When we purchase something on credit, it's money that's owing in the future. So that means it's accounts payable, which is a current liability. So we've got $5,000 here increasing. We're also getting office equipment, which is increasing here for $5,000. That's our transaction. So purchase office equipment on credit. So hopefully that makes sense why it's not a cash transaction, because there is no cash being exchanged straight away. It's at a later date. That's why it's accounts payable. If it was, this is a scenario, if we are paying off that accounts payable, we would do negative 5,000 here, and then we would go negative 5,000 here. So what that has the effect of is it will then null out this. So our accounts payable balance will be then 0, and you can see we've got a cash deduction of 5,000 and the equipment here of 5,000 sitting there. So let's just Control Z that, because that actually hasn't happened yet. All right, so let's go to date number 12. Paid advertising in local paper for $600. Again, this is cash going straight out, and it's an expense, $600. And we'll just say paid advertising. Sorry about my spelling, guys. I'm not the best at it. That's why I'm an accountant. Number 13, invoiced a client for investment advice, $3,400. Now, invoicing, they're not paying us, so we're not getting cash straight away. It's meaning that we're going to get paid in the future date. So it's not cash, it's accounts receivable. So we're going to go $3,400 in accounts receivable, and our opposite side is because it is revenue, so we go $3,000, $3,400 here, and we'll just go revenue, accounts receivable. So that is that one. If we were projecting and they actually paid the money, let's have a look at that account, what it would actually be. We would go 3,400 because we're getting the cash in the bank, and then we would deduct here 3,400. So what this does is this transaction would then delete, in essence, your accounts receivable balance. There'd be nothing there, and you'd have the 3,400 cash here and 3,400 cash revenue there. But that's not occurred yet. There we go. Okay, let's go for the last one. It's the 14th of October. Paid wages to a casual staff member of $1,300. Again, wages is an expense. We go negative 3,400. Over here, it's an expense, negative 1,300. I think I'm getting tongue-tied. So we'll just go paid wages here. All right, that's it. That's all our transactions done. Now what we need to do is very important. It's write closing balance. We then sum up everything. Now if we had opening balances, we would also include the sum of the opening balance. So right now we would be summing up. I'll just show you. We would sum up all of this. So the sum of that is $40,020. Okay, next column, we've got the sum of 3,400. The next column, well, we've got no accounts there. We jump over here, is $10,000. The next column here is $5,000. The next column here is $5,000. So equity, it hasn't changed. It's still 50,000. And then over here, if we sum up all of this here, all of that, if we sum all of that up, we've got $3,420. So we're up, we're in profit. So how can we really check what we've done? How do we reconcile it? So if we remember, liabilities plus owner's equity equal assets. So in theory, if we add these together, let me make sure I've got correct. So let's do that. A blue If we add those together, let me get my calculator up. 3420 plus 50 plus $5,000. I'm just going to write it here. You don't have to do this. 58420. Might highlight that blue so you can see the difference. And then if we add these together, let's make you dark purple. So we go 4020 plus 3,400 plus 10,000 plus 5,000 equals, I'm just going to write it here for you, 58,420. So we'll highlight that purple. So if we can see that, 58,420. Our working sheet reconciles. Wonderful. We've done a great job here. So everything works, and that's how you do it. That's how you complete this working sheet. So hopefully that's not too hard after I've really gone through it and tried to explain it for you. If you have any questions, post it in the comments box below. But just keep in mind, if you are given opening balances, you need to complete up the top here. You need to put in your opening balances here of the applicable account. And then if you do have opening balances, it is the sum. You need to include it in the sum, the total of the closing balance. Because your closing balance, the formula is your opening balance plus the movement during the period, which equals your closing balance. Okay, I hope that all makes sense. Good luck, everyone. Thank you.